Hi, thank you everyone for attending today's webinar. My name is Allan Madan from Madan Chartered Accountant, and we'll be reviewing small business tax tips. There is a chat area in your window, so if you would like to ask a question, please type it. We'll reserve about 15 to 20 minutes for Q&A, and the presentation itself should take about 15 to 20 minutes itself. Okay, so we'll get started. The small business tax rate. The corporate tax rate has actually gone down. So at one point it was 16.5%, but now it is 15%. And one of the changes that's happened is that Mr. Trudeau actually put a stop to any further reductions. So the rate was actually supposed to drop over the next 3 years to 13.5%. It is now capped at 15, okay? Now that's on the first $500,000 of business income. And we'll update the slide here because that rate's a bit dated. The individual tax rate. Again, there's a new tax bracket for those earning more than $200,000 per annum. The new tax bracket is 33%. So if you factor in provincial tax plus federal tax, the rate comes to 54%, okay? Let's go on to the next slide. I wanted to talk about briefly the personal service business rules. Now, these are a set of rules in place to essentially discourage employees from incorporating a business in order to take advantage of the low business tax rate of 15%, okay? So let's say you're an independent contractor and you've been approached by a bank or a technology company or any company for that matter to work as an independent contractor and not an employee. What that means is that your employer, really your customer, will not give you a paycheck on which taxes are deducted, but rather they'll pay your company, okay? And so your company will charge them GST or HST depending on the province that you live in. Obviously, there's a big advantage for independent contractors to incorporate their company rather than being an employee. And I think that's self-evident from the previous slide when we compared the rate of 15% for a small business versus 54% for an employee at the highest marginal rate. So to stop this practice from happening, the CRA has what's known as the Personal Service Business Rules. And it punishes an employee for incorporating a business to take advantage of the low rate. The punishment is that the CRA assesses a special tax rate which effectively increases the tax rate for the small business up to 54%. So you're basically in the same position as if you had never incorporated in the first place, okay? So what are these tests? How does the CRA determine whether or not a business is a personal service business and therefore subject to the 54% rate? Well, one of the factors is control. If your employer dictates when you're to do the job, how you're to do the job, what time you're supposed to arrive, what time you're supposed to leave, they essentially have control. We have a little slide here with a puppet, but essentially that's getting to the heart of it. Do they control the way that you work? In today's age with professionals, usually professionals are given a lot of leeway. So I would say that it would be difficult for the CRA to demonstrate that the customer or your employer exercises complete control over you. What I'd further suggest is that when you sign your contract with your employer, put something in there that the service provider, which is you, the independent contractor, can choose the hours and where the work is performed and how and when. Okay, that would demonstrate that you have control. Can we go to the next slide, please? Tools and equipment. I'll give you an example. Let's say that you're a truck driver, okay, and you've incorporated your company because you don't want to be an employee, and your customer pays your trucking corporation directly. Now, you don't own the truck, let's say. Rather, it's the customer that owns the truck. You're simply driving it. If you supply your own tools, like your safety equipment, your goggles, maybe a repair kit for the truck, you could argue that you're supplying the tools and equipment to perform your job. Okay? To the extent that an individual supplies his or her own tools and equipment, they are more likely to be considered an independent contractor versus an employee. The next one, please. Subcontracting work. If you have the ability to subcontract part of your work, that's excellent because it demonstrates that you are an independent contractor as opposed to an employee. Now, your customer may not be happy with that, but maybe you could subcontract the clerical portion of your job to a spouse perhaps, and that could include bookkeeping, filing, administration, etc., etc. Okay? Next slide, please. Financial risk. If you don't take any financial risk whatsoever, then you're more likely an employee. Like, what's financial risk in the first place? Financial risk is the opportunity for profit. So maybe you're paid, instead of a salary, an hourly rate. The more hours you bill, the more you make. Okay, there you have some opportunity for profit. Financial risk also means losing money. So you're paying for some expenses. That could be things like your home office rent, your cell phone, your internet, your car expenses for your job, any other incidental expenses that you have to incur. Okay, so I would put in the contract with my customer that as an independent contractor, I'm responsible for paying for any expenses necessary to carry out my services, and I bear the financial risk of those expenses. Okay, something like that. Next slide, please. Opportunity for profit, we've kind of already talked about that one, if we can move on to the next one. Financial dependence. This is important. Now look, if you only have one contract, there's a risk that you could be considered an employee because you're financially dependent on a single source of income, which is your single customer. However, if you have more than one customer, there's a good chance that you could be considered a independent contractor or a self-employed person. I would suggest that you aim to have more than one contract. Even if the other one is a smaller contract, it still demonstrates that you have more than one. Okay? Okay, tax on investment income. This is important for small businesses because many small business owners essentially try to keep as much cash inside their corporate bank account rather than distribute it to themselves. We know the reason is because when the cash is distributed to a shareholder or an owner, they have to pay personal taxes on that. So to avoid or defer paying personal tax, everyone stores their cash inside a corporate bank account. Now, what do you do with it? Well, if you do nothing, your money's not working for you, and it becomes less and less valuable because of inflation. So you could invest it into bonds, for instance, or any income-producing investments. Here I'm talking about interest income, and interest income is fully taxable to your corporation at its marginal rate. Okay, now the corporation pays an approximate tax of 50% on investment income. Okay, now you can get some of that tax back. It's a little complex for this presentation, but you can get some of that 50% back if the corporation pays a dividend ultimately to its shareholders. And roughly, what's the corporate refund that the corporation will get upon paying those dividends? It's about 26% of the 50%. So the effective rate when you factor in the corporate refund on dividend payments is roughly 24% on interest income. Okay, that's 50% minus 26% corporate tax refund. Okay, could we go on to the next slide? Dividend income. There's two types of dividends, okay, eligible dividends and ineligible dividends. The way I look at it is eligible dividends are from big companies, ineligible dividends are from small companies. More specifically, eligible dividends are paid out of corporate profits in excess of $500,000, whereas ineligible dividends are paid from corporate profits below $500,000. Why the distinction? Well, eligible dividends carry with it a very low tax rate for the recipient of those dividends. Likewise, ineligible dividends carry a higher tax rate for the recipient of those dividends. If you are an owner-manager of a small business and your corporate profits are less than $500,000, you most likely are receiving ineligible dividends from your company. On the flip side, corporations can invest in dividend-producing investments themselves. They may buy stable stocks like a utility company or maybe a great brand such as Coca-Cola and receive quarterly dividends. Those dividends are subject to a special tax called Part 4 tax. Okay, so the corporation will pay approximately 33% tax on portfolio dividends received. That is, dividends on stocks or stocks or investments that they have. Okay, so that's about a 33% tax rate. Now, like the interest income example previously, a portion of this tax can be refunded upon payment of a dividend to the ultimate shareholder. The refund rate is 26%. Okay, could we go into the next one? Capital gains. Okay, capital gains are 50% deductible. What that means, another way to say it, is that capital gains are only half taxable. Okay, and that's a really great incentive for small businesses to invest in either capital property or in land and building, or even other capital that could grow their business. Perhaps you just want to invest in stocks because you want some passive income, but nonetheless, capital gains are half taxable. Okay, if we could go to the next slide, please. Tax-free car allowance. Okay, if you have a car that you personally own, but you use it for your company to carry out your job duties, then you can receive a tax-free vehicle allowance from your corporation. Okay, how does it work? Well, you submit a log. You can either do it weekly or monthly of the kilometers that you drove during that period, and then your corporation writes you a check. The formula is 54 cents for each kilometer that you drove for work up to 5,000 kilometers, and 48 cents thereafter. Okay, so this is a great way for an employee of a corporation, including an owner-manager, to extract tax-free money from their corporation. Now, the key is you have to be an employee in order for you to take advantage of this tax-free allowance. This slide is dealing with the employee home purchase plan. Many small business owners, as we discussed previously, have a lot in retained earnings, and they want to perhaps buy a principal residence, maybe upgrade from their existing one. Now, how can you access that cash on a tax-free basis from your corporation? If you don't plan for it, so we just want to go back a little bit earlier. If you don't plan for it, then what will end up happening is that you're going to take out a bonus or a dividend from your corporation in order to fund your house purchase, and you're going to pay personal tax on that. So let's say you take out a $100,000 bonus from your corporation. Now say goodbye to maybe $50,000 of it if you're in a high tax bracket. What if, however, you could borrow the money from your corporation, okay, and reinvest those proceeds, that loan money, into making a down payment on your new home that you're going to buy? Okay, so there is such a thing. Some of the conditions are you have to be an employee of your corporation, so you have to be on payroll. The other condition is that the terms of the loan must be reasonable. Okay, and so this is talking about interest. So you have to pay a market rate of interest to your corporation on the loan money that you received. Number 3, the repayment terms have to be reasonable. And so this is what this slide is alluding to, step 3. That's usually like a 25-year amortization period, not a 40-year amortization period for you to pay back the loan. Okay. The corporation also has to take back security. And what I mean by that is that it will register a mortgage against your home. This will be, in effect, a second mortgage because the bank whom you're borrowing the majority of the money from will likely take first position on the home, so your corporation would rank behind the bank. Okay, if we could go to the next slide, please. Okay, home office write-offs. Many of you may have a home office because you work from home maybe all the time or some of the time. Okay, but you can actually deduct a portion of your house costs. And the deductible percentage is computed by taking the size of your home office divided by the total area of your home. Now, an example could be if I have a 3,000 square foot home and my office is 300 square feet, I can then deduct 10% of those costs. Okay? And what are those costs? Utilities, property taxes, repairs and maintenance, home insurance, and mortgage interest. Okay, that's a big one. Could we go on to the next part? Okay, this is an example. I'll let you read through that earlier, but it's following the same principles that we just talked about. Corporate life insurance. Okay, I think this is important to know. Death and taxes, those are two words that you can never avoid. It's inevitable, okay? But, you know, many people don't plan for what happens after their death. And it's really important that you do. I know it's not a fun topic to have, but, you know, you have family members. You may have a child or a spouse, and God forbid something happens to you. You know, how are they going to support themselves? So you should consider buying an insurance policy. And the insurance policy should have a sizable death benefit so that your beneficiaries, your family members, can live comfortably because they've lost your primary source of income. I think that, I really believe that your corporation should purchase the insurance policy. That's because it allows the corporation to pay the premiums from after-tax corporate dollars, as opposed to you having to take out money from the corporation, pay personal tax, be left with a very small portion to pay then for those insurance premiums. Okay? Now there's 4 points here I listed. Number one, it's a tax-free benefit. Okay? So when you pass, if your corporation owns the policy and your estate is named as the beneficiary, your corporation will pay the death benefit to your estate. And that is a tax-free payment. So if it's a $500,000 death benefit or $1 million death benefit, that will be paid tax-free to your estate. Number two, tax-free growth. Many of you may not know this, but most policies nowadays are known as universal life insurance policies. They actually have an investment component, and you can fund this policy so that a good chunk of it is actually invested in stocks, bonds, and mutual funds. And some of these companies have a very good historical rate of return. They operate kind of like a pension fund, giving their clients 7 or 8 or 9% historically. But the great thing is the money invested in this policy is not subject to taxation, so long as it stays in the policy. Kind of like an RRSP, right? Number three, we talked about cheaper corporate dollars. That's the same point I said earlier. Have the corporation pay for the premiums and not you. Number four, creditor-proofing assets. Funds held within the policy are off hands from creditors. So if someone sues your company, they can't touch that money. Okay? GST, HST, quick method election. Many of my clients really do benefit from the GST, HST, quick method election. And we also have a video on our website that shows you how to make this election and how it works. But generally speaking, there's two methods, okay, for HST collection. First off, you all know that you have to collect 13% from your customers if your sales are more than $30,000. Under the traditional method, when you file your HST return annually, you get a rebate for the HST paid on business purchases. And that rebate is subtracted from the HST collected, so the net amount is what you pay the government. For example, if you collected $13,000 from your customers, but you paid $2,000 of HST on business purchases, you have to give back $11,000 of the $13,000 to the government. The quick method is also a simplified method. What it is, it's based on a formula. And here's how the formula takes. You take your total sales, including HST, and multiply it by 8.8%. Subtract that amount from the HST you collected, and you can collect, or pardon me, you can keep the difference. So let's think about this. Okay, so I collected 13%, but I'm really only giving back 8.8%. That's a pretty good deal, especially for those businesses that don't have a lot of HST paid on business expenses. Okay, you do have to elect for this before, I believe it's in your first calendar quarter of the year, and it's form GST 74. Okay. Who can use the quick method? Small businesses with sales below $400,000. On the next slide, you'll see that certain businesses are prohibited, or on this slide, I mean accountants, lawyers, and charities. They can't use this method. Okay, let's go on, please. Okay, this is an example. I'll allow you to read that at your leisure. Okay, employee benefits and tax deductions. This is important for small business owners to understand. Stock options for employees. If you are remunerated partly by stock options, you should be aware that you can claim a 50% deduction on your tax returns. So the entire stock option benefit is not taxable to you. Only half of it is, providing you meet certain conditions. So for example, let's say my employer grants me a stock at an exercise price of $1, okay? and 3 years later the shares have vested, and the company's flying high and they're worth $10 a share. So I have a benefit of $9 a share. $10, which is the market value, minus $1. That's what I have to pay for it. That's my exercise price. So rather than have the whole $9 included in my income, if I meet certain conditions, only $4.50 will be. It's kind of like capital gains treatment for stock options. Okay? Other benefits, company car. If your corporation owns your vehicle, you have to understand that there is going to be a taxable benefit accrued to you, and that taxable benefit is known as a standby charge and operating cost benefit. Rather than bore you with the formula, what it essentially means is that because you have the privilege of using a company car, you're going to have to pay a tax on a standby charge benefit. Number two, because the corporation which owns the car is paying for the operating costs, there's something known as an operating cost benefit that you have to include in your income. Okay, if you go to my website and type in standby charge or operating cost benefit, you'll get further information there. Another good benefit, and this is actually, it could be taxable, home internet and company cell phone. If you really don't use this for business purposes at all, but it's a freebie from your company, it's fully taxable to you. On the other hand, if you're just being reimbursed for the portion that you use for business, maybe it's 50%, then it's not taxable to you. Okay. Employee benefits and deductions continued. These are good points. I'll let you read them, but they're a bit in depth, so we'll go to the next slide. Budget highlights. So we talked about the new bracket for the rich, or the top 1%. The new federal bracket is 33% for those earning more than $200,000. If you're part of the middle class, those earning between $45,000 to $90,000, the bracket, the federal bracket has dropped from 22% to 20.5%. Could we continue on? Thanks. The incorporation costs, any incorporation costs that you can incur can be completely written off. Before, you had to amortize them on a very slow basis, 7% per year. But now, legal costs paid for incorporation or accounting fees paid for incorporation are fully deductible in a year. Now, there's been some rumors about the business tax rate for small businesses. And what happened is, what has happened in Quebec is that as of 2017, the small business tax rate will only be applicable for employers that have 3 or more employees. So they're trying to basically stop, a one-man show or a one-woman show from incorporating their business and taking advantage of a small business tax rate of 15%. So if you're in Quebec, tough luck. You're not going to take advantage of the small business tax rate. However, the federal government has not yet followed that position, and there were rumors that they would, but thankfully they didn't. Now, I don't know if in the future they're going to change their position and say that the small business tax rate only applies to corporations with at least 3 employees, but time will tell. Okay, that concludes the slide portion of our session. I hope we stayed on on time, about 20 minutes. Any questions? You can please type in your chat window, and I'll be happy to answer them for the next 20 minutes. Matt says, do the PSB rules apply to self-employed individuals, unincorporated, that are invoicing businesses as well? No, the PSB rules are specific to incorporated business. Any other questions? Okay, we'll just see if anyone else has a question. Don't be shy, I promise I'll answer. No question is a silly question. Okay, it looks like there aren't a lot of, oh wait, there's another one. Can disability insurance be paid by the company? Yes, disability insurance can be paid by the company. It is also tax deductible to the company. Any other question? Okay, James says that any limit on the amount that you can take out of a corporation is a tax-free loan. Good question, James. The amount of the loan has to be reasonable. So let's say you're a salaried employee of your company with a remuneration of $50,000 per year. So that's what's shown on your T4 slip. To me, it would be very unreasonable if you got a $200,000 loan from your company given your salary. So you always have to use some common sense there in that the amount of the loan should be reasonable in relation to the type of job you're doing. Glenn was typing a question, but I think he maybe stopped. Okay. Well, this concludes the Q&A session of our presentation. If, however, there are any questions, please email me. Okay, I'll answer this one last one, and then and could you put my email address in the chat window, please? That way, my email address is being written right here. You can feel free to email me after this presentation, and I'd be happy to answer your question. Glenn asks, without selling the company, just closing it down as no longer doing active business, is there any method to capitalize on the lifetime capital gains exemption? You could. Basically, it involves a Section 85 rollover, and you can crystallize the cost basis of your shares by bumping up their cost amount to $800,000. You won't be taxable on that, but I want you to understand this isn't like a tax scheme for you to take out money out of your corporation tax-free. All you're doing is bumping up the cost of the shares that you own in your company, so that if you do sell them in the future, you've locked in that $800,000 in the cost basis of your shares. Okay, thank you again very much for joining this presentation. Feel free to email me, and we'll see you next time.